Day trading is the term used for buying and selling securities like stocks, currency, commodities, and futures within the same day.
What's up, you guys? Welcome back to my channel. In this video, I'll be diving into the thrilling world of day trading, the art of making quick, informed decisions in a fast-paced financial market. So to start off, what is day trading? Day trading is the act of buying and selling a financial instrument within the same day or even multiple times over the course of a day. Taking advantage of small price moves can be a lucrative game if it's played correctly, yet it can be dangerous for beginners and anyone else who doesn't inherit to a well-thought-out strategy. So I will be discussing the key strategies and tips for any average day trader. So day trading requires a unique set of skills and strategies. We'll explore this intraday market dynamics and equip you with effective tips to enhance your chances of success. So buckle up, hit the like button, and let's get started. So first things first, understanding intraday market dynamics is crucial. The market moves fast. The trends can change in the blink of an eye. As day traders, we need to be aware of key factors influencing price movements. These include market news, economic indicators, and overall market sentiment. So let's talk about knowledge. Knowledge is considered in trading very powerful. Day traders need to keep up with the latest stock market news and events that affects the stocks. This can include the Federal Reserve's interest rate hikes that were happening previously, or the leading indicator announcements and other economic, business, and financial news. So when we consider the fact of keeping an eye on live charts and breaking news to stay ahead of the curve, it's like being a detective, always looking for clues that might impact your trades. So if we talk about strategies, successful trade trading is not about making random bets. It's about having a throughout plan. One popular strategy is a trend following strategy. As you can see, there's many type of ways. You can also say what makes day trading difficult, deciding what and when to buy. So if you consider the steps of like pretty much what makes it so difficult, day trading takes a lot of practice. There are several factors that can make it challenging. So first, we need to know what you're going up against. Professional whose career revolve around trading. These people have access to the best technology and connections in the industry. There's many types of use cases, softwares, pretty much brokers that people have pretty much worked with that have many, many years of experience. These pretty much mean that they are set to succeed in the end. If you jump on a bandwagon, it usually means more profits for them. So then you have to also understand that Uncle Sam will want a cut off your profits. That's what I was mentioned by brokers. No matter how slim, remember that you have to pay taxes on your short-term gains, investments that you hold for 1 year or less at the marginal rate, and upside that is your losses will offset any gains. So I will be discussing a little bit about the video I'm going to be showing to you guys momentarily, like pretty much what are the 4 key elements, what day traders look for, and what they decide when to buy and what to buy.
Most experienced and professional day traders usually follow a plan involving 4 main strategies: security selection, determining entry points, finding a price target, and determining placement of a stop loss.
As you can see in the video, there's 4 key strategies what every day trader investor looks into. And when we're deciding what to buy, day traders try to make money by exploring the minute per minute price movements in individual assets, stocks, currencies, futures, and options, even cryptocurrency. They usually leverage large amounts of capital to do so. So in deciding what to buy a stock, say, a typical day trader looks for 3 things. It's liquidity, volatility, and trading volume. So let's talk about volatility. This is a measure of the daily price range, the range in which a day trader operates. More volatility means greater potential for profit or loss. If you also consider liquidity, it's a security that liquid allows you to buy and sell it easily and hopefully at a good price. Liquidity is a average with a tight spreads. Or the difference between the bid and ask price of a stock, and for low slippage, or the difference between the expected price of a trader and the actual price. So identifying and writing trends can be highly profitable. looking for strong, sustainable price movements and align your trades with the prevailed trend. But remember that trend is your friend until it bends. So that's what they always say with trading volume. It's the measure of the number of times a stock is bought and sold in a given time period. Is commonly known as the average daily trading volume. A high degree of volume indicates a lot of interest in the stock. An increase in the stock's volume is often a harboring of a price jump, either up or down. So day trading pretty much involves a lot of risk, and managing the risk is a paramount. Never risk more than what you could afford or lose in a single trade. A good rule of thumb is the 1% rule. Never risk more than 1% of your trading capital in a single trade. So when we consider exactly setting aside the funds, like this is a good example. Like if you assess and commit to the amount of capital you're willing to risk in each trade, many successful day traders risk less than 1 or 2% of their accounts per trade. So let's say you have a 40,000 trading amount and you're willing to risk half of the 1% of your capital in each trade. Your maximum loss will be per trade will be like 200 when you multiply the 0.5% by the 40,000. So you can also pretty much implement the stop loss orders to limit potential losses and always have an exit strategy in place. It's not about just making profits, it's about protecting what you have. That's what they always say. Cut your losses with limit orders. If you decide what type of orders you will use to enter and exit trade, you will use market orders or limit orders, which I'll be discussing in a different future video. Market order is executed at the best price available at a time with no price guarantee. It's useful when you just want in or out of a market and don't really care about getting filled at a specific price. And whereas a limit order guarantees price but not the execution. The limit orders only can help you trade with more precision and confidence because you set a price at which you want to be executed at, and then pretty much the limit order can cut the losses on reversals. However, if the market doesn't reach your price, your order won't be filled and you will maintain your position. So that's something that's very crucial. So more sophisticated and experienced day traders may employ the use of option strategies to hedge their positions as well. So technical analysis is a day trader's best friend. Learn how to read charts, identify specific support and resistance levels, and use technical indicators to make informed decisions. Whether it's moving averages, RSI, or MACD, these tools can help you spot potential entry or exit points. Remember, it's about stacking the odds at your favor. Like I said, the chart patterns, like I'm going to describe a little bit on trademaster.at. There's different type of chart patterns that many day traders look into. They also use head and shoulders, double top and bottom, the triangle, the ascending, descending triangle, the cup and handle. So to describe a little bit of the head and shoulders, this pattern consists of the three peaks, where the middle peak is the head being higher than the other two peaks, which is the left shoulder and the right shoulder. As you can see, the baseline right here. So it's pretty much suggests that a potential trend reversal from bullish to bearish. As you can see, we went into a bullish momentum. We retested the baseline. We went up to the higher peak. And then, like I said, we go ahead, test the baseline again, and we form the right shoulder, and then we go into descending bearish sentiment. And if you talk about a double top and bottom, this price pattern occurs when the price reaches a high double top or a low double bottom twice before reversing. It indicates a possible trend reversal. So as you can see, there's the M and there's the W. The M is pretty much testing the trend lines. And as you can see, it hits the trend line, retests the baseline, hits the trend line, and goes in the reverse. And then the opposite is with, we can say, the double bottom chart pattern. And as you can see, when it comes to triangles that are ascending, descending, you can see ascending triangle, it goes into this pretty much brace of the trend lines with these brackets to determine if it's going to be an outbreak or if it's going to be a downtrend. So as you can see, as ascending and descending is pretty much explanatory into the charts. And with the cup and handle, this pattern resembles a cup with the handle. So as you can see, original bullish trend, you go up, you hit the upper resistance line, you pull back, you pretty much hit around the bottom. And then, like I said, you hit a substantial raise. Then you hit pretty much the handle, downward slope, and then a breakout continuous of a original bullish trend. So these are some things that you can consider when you do day trading. There's a lot of indicators every day trader uses to position themselves for future trades. So there you have it, guys. The art of day trading involves a combination of understanding market dynamics, employing effective strategies, and managing risks. If you found this video helpful, don't forget to subscribe, hit the bell icon for notifications, and share with your trading buddies. Keep honoring your skills, stay disciplined, and may the markets be ever in your favor. Happy trading. I'll catch you in the next one. Thank you so much.